So we are doing our book club today. We are reading Rich Dad's Guide, Advisor Guide to Tax-Free Wealth. And we are doing, what did you just say? I forgot. 15 through 19?
Yes, ma'am.
Okay. It's been a hard book to keep up with the chapters because of the way they have them in the audiobook.
Yeah. All right. So
Awesome.
this kicked off the part two of the book, which was your tax strategy for tax-free wealth. So this definitely, especially first chapter 15, jumped into how you can do this yourself. So in a way, it became self-guided, and I think each of us will take our own perspective of how the book rolls out from here. So with chapter 15, the plan to take control of your taxes and then entities was their key thing. So I wanted to ask everyone here, because there's, you got trusts, partnerships, corporations, LLC, in a combination, and was wondering if anyone would want to share, what's their strategy plan around their entities, and do you have just one, or do you have a combination, or what are your thoughts of what you want to do if you don't have anything yet?
So I'm still ironing mine out, but I have and I actually sent this to Craig recently, but I have an actual entity org chart. So it's like an org chart, but for like your businesses, the way it's set up.
Wow.
So at the top, it's like a Wyoming's LLC holding, and then it kind of rolls into a corporation, which is Real Advancements, which manages just about everything, which is awesome because then he kind of talks about managing managing different entities as an S corp, to essentially avoid uh, employment, or unemployment taxes, or not unemployment, darn it, self-employed taxes.
Like the government taxes, I guess, is Social Security and Medicaid. Yep.
Yep. So for me, I'm set up as a corporation. I don't know that that was the wisest way to set up. And again, I think for me, it goes back to not the best tax planning advice. I set up as a corporation because that's how my mom set up years ago. And I was always told that was the best way to set up. And that was what I was supposed to do. And so as an obedient child, I just did it. Craig and I were actually listening to this on the way home from Louisiana, and we were kind of talking about it a little bit. The rest of everything else we have set up is set up as an LLC. At least as far as our rental properties go. And then we're also looking up setting up a foundation. So we have started really, the last few chapters, they start talking about retirement plans, and that kind of got our gears turning and burning. And, you hear all the things that you're supposed to do with your IRAs and your 401ks and all that kind of stuff. And now that's all in the toilet based on this book. But I think that's going to be something that probably our Q3, Q4 in 2024 conversations with the companies that we're interviewing, that's going to be a huge point of conversation, because he not only talks about tax strategies, but also asset protection. And I think that comes kind of either right at the end of what we were originally talking about in part one, or kind of right here at the beginning of part two. I can't really remember what chapter it was in. But as I look at things, even our Louisiana house, like it's in an LLC, but we separated the back part of the property. And I think that's just in our trust. And there's things that we could be doing with that property that I think potentially could give us some tax breaks, or, whatever. So for me, and probably for Craig too, it's going to be really sitting down and evaluating that, because I think that we've done okay. I just don't know that we're set up perfect.
Mm-hmm. Yeah, but you got to consider everything, like your tax plan, your wealth strategy, and your retirement plans, and how you're going to execute all that.
Yeah, I think that's kind of how that's definitely a work in progress as we're kind of moving forward, and also as we learn more and more on the tax side of it. And from the entity structure and the legal liability structure, we have a mix of LLCs and trusts, and then our corporations. I think, Laura's, as you said, she's a corporation, taxed as an S corp. My law firm is a PC, professional corporation, which is the same thing as a corporation, just technically all the shareholders need to be, it's part of a profession, obviously, and all the shareholders are supposed to be part of that profession to do so. And I'm actually working through that piece of my puzzle, as well as and so now we have a lot of parts that ideally everything is flowing down to a trust as of now. We are adding that foundational piece, which may be kind of a more of a CRAT, which is a charitable remainder trust, I guess, that's created, that kind of flows everything down instead of kind of going into some for some tax issues to avoid that, some taxes down the road. So we're going to add that piece and put that into the puzzle, and then tie in the rest of it. And I think we have a really good structure that needs to all be now buttoned up a little bit, from a liability perspective and from an installation, and kind of getting it each a separate profit center, if you will, or life center is protected in a little bubble. But now we're working on taking all those bubbles and put them into a big bubble, which kind of gives it a nice cohesive plan on that, as well as for me in particularly. And it's as well as, I think, also for, I guess, realtors and CPAs, because in the sense of sharing a fee shares when it comes to professional corporations, we're all professionals and we're all licensed facilities. I know for particularly with attorneys, it is very difficult to have it where non-attorneys are owning law firms. For medical practices, I think that works. A lot of times you'll have an investor that opens up a medical practice and hires a doctor to actually run it, and they share the fees that are generated. Unauthorized practice of law prevents me from sharing my fees that I generate with anybody other than another lawyer, which in my opinion, which would include family, right? So, tying into that situation and even adding some of the asset protection classes that he was talking about in regards to a corporation that's owned with shares that is subject to forfeiture, if you will. Not easy, but it is subject to forfeiture, where you potentially lose a company by losing your shares, as opposed to LLCs where there are charging orders and things like that, where you can never actually take over the business. You can put a lien against distributions, but that's kind of what you have with the LLC side of it. And then kind of tying that in from an estate perspective for my personal is kind of where I'm kind of working through that piece of it, because I want to keep it from a seamless transition if something does happen to me, that all my business and everything else kind of stays within my family, those interests, but with avoiding my family getting in trouble for unauthorized practice of law by taking legal fees when they're not attorneys. Yes, so we have a nice structure of mostly LLCs with some trusts and with some corporations mixed in there, that now we are kind of tying back into kind of more of a cohesive plan.
Nice. Well, that's good. Well, I'm excited. I'm glad that this book has got you guys thinking about structure and hopefully benefits to your businesses. I felt chapter 16 kind of played off of chapter 15. It was protect your wealth from pirates, predators, and other plaintiffs. So, and again, it dove into the trust, the different entities, the trust partnerships, corporations, LLC, and the combinations of those. Did you guys have any additional items on chapter 16?
Well, for me, it just told me how much I don't know. Like in my head, you hear, oh, form a corporation and then you're protected. Well, I don't think I'm protected from all the plaintiffs.
I think that's probably the bigger things is, what are you protecting yourself from, right? For the most part, forming an entity protects your personal assets from your entity at work, if you will. but doesn't protect you per se from your individual issues, right? Okay. Rental homes, right? You knew that you had a falling staircase and you decided not to fix it because you didn't want to spend the money, and you knew about it, and then somebody trips and falls through the broken staircase. Now you potentially have an intentional tort or something because it was a dereliction of duty as a landlord to provide a safe place, and it's something you had knowledge of. But at that particular point, they may come after you from a personal standpoint, right? So at that point, now I'm trying to protect my assets going from up the chain as opposed to down the chain, right? And so that was a nice little piece that he would add that was interesting, is a lot of times you're creating kind of making sure that your company is formed to prevent the down chain, people kind of going through the company to come after you, as opposed to getting to the company from coming up through you, right? So you got to kind of put blockers on the bottom part and the top part, which was a nice little piece that he's talking about. Now some of the charging order information that he's talking about, and losing shares through personal, it was something you did on a personal level as opposed to a corporate level, which was a different take on asset protection and forming companies. From the top up as opposed to the bottom down. I don't know if that makes sense.
It's neat because I mean we definitely all come from different backgrounds, so I love that we get your perspective from the legal side, and then Damon's perspective on the accounting side, and then of course the real estate perspective from Laura. So I learn a lot from just you guys, because there's pieces in here that you guys understand way more than maybe even the author does. So thank you. Okay, so I think this next chapter 17 applies to all of us. Plan to retire rich, not poor. I think that's all of our goals right there. Summed up pretty well. Interesting perspective there. A little bit scary to think that you're going to be retiring in a different tax bracket than what you are today, because of now you're losing all your tax benefits of being a business owner or owning all the real estate or all those other tax write-offs that you used to have, and now they're all gone away. So definitely opened my eyes thinking about, when you meet with your financial planner and they tell you how much millions of dollars you're going to have someday when you finally get to retire. It's like, oh crap, you're not going to get to take all that home because you no longer qualify for good breaks.
Yeah. So this was probably the most eye-opening chapter so far, and I was pissed. I was so angry at the end because, for the last few years, we've been told by our CPA, oh, do a $10,000
deferral
for his, we may have done like a $30,000 one at some point. Like we've put some big chunks of cash in an owner K for Craig to have deferred taxes. And the first thing that comes out of his mouth in this is, well, unless you're planning on retiring broke and retiring in a tax bracket lower than where you are because you have less income, it's a terrible strategy. And I think to myself, oh my God, like, what if that money, instead of being in that stupid owner K, was sitting in another rental house that we have?
Mm-hmm.
Like, I would have much rather have paid the taxes on that money and then taken depreciation. That would have been a much better tax strategy on that, $30,000, $40,000 that's sitting in that account right now, because we just kind of started it, than us putting it in the owner K. Like I was pissed. I was ready to fire someone, both my financial planner and my CPA at that moment. Like, to not sit down and explain to me and Craig that, this is only a good strategy if your intention is making less money. Because now we've got money that we know, and thank God it's not a lot, but we've got money that we now know that has to be put, taxes on. And I don't know that we'll ever put anything in that owner K ever again. I mean, and that's kind of where we talked about having a foundation. Is it better to have a nonprofit and use, the tax break from the donation to the nonprofit over putting it in some kind of 401k? Now I do still love my Roth. My Roth is still a good thing in my brain.
Which I'm curious to see if anybody brought or I think maybe next chapters potentially, because I mean, Laura's you really hit on the. It's always been ingrained in my 401, that's the best way to save money for the future and for a retirement account and stuff like that. But it is extremely short-sighted, and the fact that that is something that I did not learn until I was 50, is kind of, I think, a poor lookout from the financial advisor world, like because it is very much, at least from a business ownership side of the equation of the four categories, right? The four charts. If you're an employee, a W-2, when you're retired, you're making no income, right? So the only thing you got is what you saved in that 401. So yes, maybe you are have a lot less, and your income is your mandatory withdrawals and things like that. So at that point, maybe, okay, I got to defer that stuff, those taxes, but a situation where you're kind of growing your wealth strategies to have multiple income streams, and the point to never really retire. The idea is to maybe work less but make more money, right? So if that is the case, that a philosophy that we're doing just to defer to a point where I still got to pay taxes that I lost, and I wasn't even going to use that money for the next 30 years. Right, I'd rather pay a little bit of tax now and take good strategies that you don't necessarily have been paying taxes when it comes to some of the stuff that he's talking about in regards to depreciation and other things that you can be doing to minimize your taxable wealth per each particular year, and not have it deferred. I mean, that is such a great hit home, if you will, to me, is that stop talking about deferral strategies and talking about tax reduction strategies, right? Because defer doesn't help. I mean, you're paying them. Like, I don't want to defer anything. I want to stop paying them.
Yeah, well, especially when you hope and plan to make more money next year. So how is that going to help you next year if you're making 10 or 20% more revenue next year, and now you just rolled that into next year as well?
Yeah, because even that whole thing I don't know when you guys hear about it, or I've heard of, the self-directed IRAs. I've had clients that come to me talking about them, and I've always been somewhat skittish because you can't make money off of your self-directed IRA, right? From a present standpoint, right? Your conflict of interest, everything has to stay within that self-directed or that retirement account, right? And a lot of people are dealing with real estate on it, and now you can deal with real estate on them, but there's so many potential rules and things that you're potentially now losing out on because everything has to stay within that self-directed IRA. And then the whole, I guess, winding it down to, don't use two tax strategies under the same strategy, right? A self-directed IRA is deferred tax strategy, and then using to buy real estate and things like that, which is also a tax strategy, and then kind of wrapping the tax strategy of real estate into a self-directed IRA, you kind of hit yourself twice in the stomach, if you will. And you're losing out everything. Not only are you paying taxes all more down the road, you're not able to take advantage of all the stuff that you're doing presently. So yeah, I don't know. I thought that was a really interesting little tidbit of information. Is don't try to use an account twice, if you will, or a strategy twice for the same thing. I guess two negatives equal positive, or that's backwards, I guess, but two positive equals a negative, right? In this case.
David, were you trying to say something too?
Probably. I forgot. It'll come back to me.
No worries. All right.
Well, I actually do have a question for you, David. Did this chapter change are you working with a self-directed Roth IRA or just a self-directed IRA?
So I'm not really, so I'm working with a self-directed custodian. So the custodian just does all the compliance. And then I actually essentially invested in what's called an IRA LLC. So it's just basically the custodian will cut a check to a bank account. And then I can essentially, I'm the owner of, like, I'm the trustee. So I control everything. But I mean, that's how it's set up right now. So I mean,
have you done anything yet with it, David, or not yet?
So yeah, some of it's in bonds right now while I research essentially what I can purchase with the amount I have. And then I have like another rollover I need to do. So like, I'm like learning.
I just wondered if this chapter changed your
Well,
process
so
or philosophy with what you're doing.
gonna say, because I thought it funny that you were thinking to yourself like, oh man, like after reading this, like why do I even have it? Half of me was like, well, damn, like it's already on a bank account. I might as well just go get it and just
Spend
deal
it.
with compliance headache. But I mean, I don't know. I'd have to look and see what that actual compliance headache looks like. But it's like, you know, I just kind of thought to myself, I'm like, fuck. I mean, if that's the case, why even bother if I'm going to focus on some other tax strategy down the line? And then, I mean, if you really look at the way like tax sheltered accounts, like sponsored by the government, really work, you know, you've got like those. So Craig was kind of mentioning it, like you've got required minimum distributions if you didn't have a Roth. If your entire portfolio is not Roth, you have a required minimum distribution, which basically says the IRS is basically knocking, saying, hey, you've been holding on to this money for too long. You need to start kicking it out the door so that they can tax you on it. And when we were in school, like it's so stupid. They used to say like, oh yeah, you know, the intent is for you to not pay as much taxes later down the line. And I'm always like, accountants are just like, that's so dumb. Like taxes go up. Like we're not really seeing huge tax drops. And then on top of that, like to his point, like as you get older, you start to lose a lot of those deductions because you started paying everything off. You're just living off of, I mean, your little nest egg. And if you live off of just the nest egg, it's savings. So they're just going to tax you again.
Mm-hmm.
Yeah, that's definitely something that I'm hoping to get more information on is, you know, because again, I don't think he said don't outright use, you know, not using those type of accounts, i.e. the self-directed stuff. Because ultimately, regardless of whether you're self-directed, you know, in the sense of you're in charge of you become your own investment manager in essence, right? But you can't make, so you're able to have a lot more flexibility in regards to what you can do with the assets as opposed to a normal IRA. They're say, okay, you have three choices: safe, medium, or risky. That take your pick, and you get thrown into some mutual funds, which is okay, fine. Even though he hates the guy, obviously he doesn't like mutual funds either because
Right.
you're just the control issues, things on that nature.
So
But the IRA, sorry.
Actually, a spinoff of like an old school concept that people used to call ROBS, which is like a rollover business solution, but it's just a solo 401k. And essentially, what it was most useful for is if you just were bankrolling in your one, but didn't like your job anymore and wanted to go off on your own, well, you could essentially do a solo 401k and you could take all that money out and benefit from it. An IRA LLC is kind of a spinoff of that, but the compliance rules aren't quite as lax as a solo 401k because you're still working. So it's like you don't get as many benefits because you're still employed, you have earned income. Whereas like a solo 401, you essentially get rid of the earned income and now you're kind of going after capital gains, dividends, qualified dividends, so on and so forth.
Yeah,
That it anyway.
yeah, because I mean, definitely it seems like any IRA, 401, rollover, Roth, I guess is a little bit different. But it seems like he was alluding towards the best type of investments for those are paper investments. And then in gold bullion and silver bullion, whatever that is, but it sounds like a good thing to buy. I don't know, according to him.
Bouillon is what you cook chicken with.
Right?
I think it comes in beef or chicken.
But you know, not for real estate, which a lot of people end up buying. I know buy real estate with these. Again, I guess that's the thing we were just talked about before. But okay, using those type of accounts for if you're having kind of a mix of a strategy, which I guess I'm all for like a diversified strategy. Some bonds, some stocks, some bullion, some real estate, and some businesses as well. I mean, I guess some private equity stuff. Like, what are your all thoughts? Because you seem very adamant, like not adamant, but hey, pick one lane and don't leave it, which, holy shit.
Well, so it's funny you mentioned that. So one thing so the whenever I self-direct it, a lot of the times I don't really know exactly what people are talking about because I think there's a couple of different ways to do it. So like for instance, any tax deferred account, they have lending features. And so you can essentially like there's verbiage in the code that basically allows for you to take money out of your account and then turn around and put it back. But it's a loan and you loan against the it. So generally your custodian will do it for you and they'll do it for a fee, which is that 8%, 5%, whatever it is. But the thing, so to your point, you only have 5 years and you got to put it back or it becomes a compliance issue. And so to real estate, well, I mean, you're probably going to hold it for more than 5 years, especially if it's like cash flowing. You're not just going to turn around and sell it. Oh, 5 years is up. So it's like to your point, like whenever I hear people are investing in real estate from their 401 or from their tax sheltered account, I'm always curious how they're doing it. Like if they're just using a option or if they're actually using like specific code or specific verbiage within, like just interpreting the verbiage within the code.
Yeah,
Yeah.
it sounds like you should almost not put it there to begin with and invest it into the real estate to begin with.
Well, I think real estate tends to be the fastest, easiest place to make money just because, unlike stocks, if it goes down, it's going to go back up. If a stock goes down, it doesn't. As far as not diversifying or diversifying, I mean, I think I'm in the camp of not being super diversified because I think you have to understand each sector before you actually go in it or hire someone who really does. So if you're going to get out of real estate, like for me, if I'm getting out of real estate and I'm going to go into gold and silver and that's going to be where I'm going to start putting some money, which is actually probably the next sector that I would like to learn past real estate. I'm probably going to look for help on that because I know nothing about it until I do know about it. And so I don't know. To me, I think the better strategy is investing in what you understand and what you can be successful in. And I think for a lot of people that tends to be one umbrella. I don't know if the best strategy is just one umbrella, but I think it's just the umbrellas you understand.
I think we kind of learned that in the last book that we read too, the Rich Dad's book on investing. And he spoke a lot about all your different opportunities for investing, and almost that's a weakness of maybe some people is that they only invest where they understand. But you know, that's again where our tax advisors and our CPAs should be coming in to help us and say, I know you don't understand the silver and gold. Let me take your money and turn it into more money. And we should be able to trust those folks to help us with that without also becoming experts on silver and gold bullion.
Yes. I think a good point too is like so adding on to that, when you get into the technicalities of risk, one of them is inherent risk, is just the term for it, which is just essentially all the risks associated with the technicalities of what you do. So it's like that on top of compliance risk, financial risk, technology risk, security risk, and anything else that you can think of. It's like, well, if inherently you don't even understand what it is you're doing, you're only adding to the risk. And inherent risk is the hardest thing to fight because it's just that it's inherent. You can't get rid of it. You can only mitigate it, transfer it, or control it. Or accept it, but I mean, don't do that.
Who wants to accept it? Okay. So definitely, I think we talked a bit about the next two chapters. The business can be your best tax shelter. I think Craig, you brought up the point of how can we turn our businesses into passive income in the future and not have to work so much but still have that as a tax write-off. And then I know we just got a few minutes left, but I think the big one is chapter 19 around the magic, the real estate, and all the benefits there, and owning those. I know personally myself, I look back at my parents because they had, over a dozen rentals in their small town. And I always wondered, like, why would you ever want to do that? Why is this fun? Why are they doing this? But now I can see all the benefits that they were getting. And it's like, wow, wish they would have told me a little bit more about that, so that I would have jumped in when I was younger. But what are your guys' thoughts? We can talk about both chapter 18 and 19 about business tax shelter or the magic of the real estate.
I'm all about real estate. I mean, I understand it, and that's probably why. And to me, it seems like the easiest. But with the real estate, there are just so many different avenues and lanes, your mortgage, your depreciation, all the maintenance on the house. Literally, a piece of real estate can bring you nothing but value, and you end up, if you play it right, you pay no taxes, right? So it's an appreciating asset. If you protect yourself from liability and you have it all situated correctly, from both, how much shares do you own in that business? How do you own that business? Is it a partnership? Is it a limited partnership? Is it, what does that look like? To me, I just know that we are on the right path. We've been focused on real estate, and I think this book solidifies it. And I think as we look for an advisor, my goal is to find someone who really focuses in that real estate category, but who also understands the back end of the businesses, because the real estate has to be set up as a business and be set up correctly. But as far as, evaluating businesses, looking at businesses, investing in businesses, like, to me, that is terrifying, because you are dependent on others. Whereas in real estate, you're really just dependent on a proven market that even if there's a dip, it's still going to turn at some point and go back up.
So who's going to buy a Walgreens?
I want to find every single business that runs that way, and that's what I want to start buying.
So the Chipotle that they're building up north, going towards, it's Old Milton Parkway or State Bridge, whichever point you are on. That you could do that with Chipotle on the way to Alpharetta. They're looking to sell their business or their facility, so you can lease it back to them.
I love that. Like, why a company would do. I'm sure there's tax shelters, and I'm sure there's
Liability reasons.
But it's such a cool strategy. I would also buy a business. I would look at buying is storage units that combines a business and real estate.
I have a plan around that. Can't tell you. But let me know if you want in. All right. Well, I'm just looking at the rest of the book here. So we got chapter 20 next, and then it goes into to the end of the book, but which is about 24. But then there's some extra thoughts from the author and all that good stuff. So so for next time, we'll go chapter 20 to the end, and then we'll be thinking about the next book. Did you guys discuss it at all? Or do you trust Craig to pick one, or did you advise him?
No, we haven't talked about it. One of the two of us will take the next book, and we'll take the next two books, because David did the last one, you did this one. So it's, in essence, it's his and my turn for the next two anyway. So we will figure out which two books and who's going to lead it, and we will let you guys know next week.
Awesome.
Yes.
Peace.
Yeah.